back to the bank. There'll be some stern looks at me for saying that, but I am testifying, and I think in this case before the 29th of March, because this reflects firms that are coming to us. Getting the temporary recognition was important because that is a clear signal to firms that want, EU firms that want to have continuing operations here. For those who are running off, they need to know. I mean, if I may put it this way, the intent of the government, and I think, and the predisposition, not the details, but the predisposition of Parliament is clear in this respect. I mean, the UK is looking to facilitate ongoing commerce. But if you're running off a business, you just have to know what happens in advance.
Okay. So moving away from that back to the your financial stability report, I wanted to start with the transition from LIBOR to SONIA, which is a great acronym actually. I just wondered what progress has been made so far in amending existing contracts to reference SONIA. And Governor, I should say it's great to hear from you, but we're very happy to hear from other members of the committee as well.
Okay. So it is a great acronym. We worked a long time on that, and the industry is working on that transition. The good news is that it's very robust. There's more than 350 transactions per day, which underpin SONIA. New issuance referencing SONIA over 5 billion. All floating rate issuance in the last several months has been SONIA linked. So on the flow side, it's good news. We still have, as I think you're alluding, 80% of the cleared swap activity referencing sterling LIBOR, and so that's the stock problem. And there are some new longer dated contracts after 2021, which also are referencing LIBOR. We are working with the FCA, obviously, who's taking taking the lead on this. Welcome, Mr. Baker, and ISDA. There's two issues here. One is the risk-free rate fallback on existing contracts. We want those existing contracts to have a reference rate. That reference rate or that fallback rate is not likely to be SONIA-based. It's more likely to reference OIS and determining some sort of spread between fair spread between what was LIBOR and OIS, so the market can continue to use OIS, which will continue to function, plus the spread. But that needs to be done with industry. I mean, obviously, there's huge commercial interests on both sides on this. ISDA completed their first consultation last year. We expect further progress in this half. And then the second thing we're doing on the cash markets is working with industry on a term reference rate, so instead of spot, but out to let's say 3 months. Last point, if I may, what we have done, and I say we, I mean in this case the PRA and the FCA, there has been a Dear CEO letter that has been issued to raise awareness of the importance of this transition. I would expect, and I'll close with this, that that sort of, and I very much welcome the question and the profile on this. This will happen, and we will work to make it happen. We will work with industry to make sure it happens in an orderly way, in a fair way, but it is going to happen. It's not going back. We've made initial progress, but we'll look to accelerate it.
And yes, if I can add a point. If you look at the beginning of the year, in terms of sterling capital markets, a lot of the issuance has been by supranationals. A number of those have been doing SONIA transactions, swapped. That's an incredibly encouraging sign that the capital markets are starting to base transaction activity around SONIA, and it's what you'd look for the first sign for some development of the market progressing.
So what are the key risks of the transition? What about those who sort of likely get left behind, I suppose, and what will happen if the legacy contracts still reference LIBOR? I mean, it's sort of, it's a question of that change, and what about the laggards, basically?
Well, I mean, the issue is, as I think my predecessor said, LIBOR is the rate at which banks don't lend to each other. I mean, this is not a transaction-based market. It is increasingly, LIBOR reference rates are, they are opinion. They are interpolated by staffs of financial institutions, and they are in many cases doing that because they've been encouraged to do so by regulators in order to have an orderly transition. At some point that is going to stop, and so you're going to have a contract that references a fiction. and a contract which has real economic value. So it is very important that this transition proceeds. We have something, as Mr. Sharp just alluded to, something that is working, and having supranationals come in, the most sophisticated borrowers in many respects in the world, come in to issue floating rate SONIA is a very good sign. So we have something that works, is based on underlying transactions, and you have a choice of moving towards reference of that, or increasingly referencing a fiction, an orphaned fiction, if I can put it that way, so potential large economic costs. Now, last point, financials, from a financial stability perspective, which is why you're raising it, it is hugely important that this is an orderly transition and a fair transition. And I would say that, and commend the CEO of the FCA, Dr. Bailey, for his leadership on this. It's hugely important that London is, in many respects, the home of LIBOR, leads this transition.
And just finally, for me, impediments. What are the impediments? What would prevent people from making this move? What would the bank need to do, or the FCA or others, to tackle any impediments? Mr. Sharp?
Well, maybe I'll start. I referenced the fallback, and so getting that right is hugely important, and so there's a judgment about what spread one would use, what underlying reference would use. That's why ISDA has been very deliberately conducting a consultation. There'll be follow-up consultations. I mean, it's actually ongoing right now. That is an impediment because there's big economic. I mean, these are trillions of sterling in contracted and analogous in the dollar market amounts, a much bigger amount in the dollar markets, and there are big economics in this. So it's important that it's done in a fair process and we get the right answer. In the end, like in many complicated and difficult things, someone has to make a decision, and so you have to come together to make a decision about a complex issue, and I'm confident that in this case that's what will happen.
Very good. Catherine.
Thank you, Chair. I want to ask you just about some of the assumptions in the 2018 stress test. That includes GDP falling by 4.7%, higher unemployment, house prices falling by 33%, combined with a bank base rate of 4%. In the circumstances described, why would the interest rate be so high compared to the current rate?
Yeah. So I think what's important here is to distinguish between assumptions and outputs in the stress test. So what happens in the stress test is we take a series of judgments about real economic shocks, and then we propagate those shocks through to the economy and financial markets. And then there is a response of policy. We make a mechanical response of monetary policy. So we use a decision rule for monetary policy. In the jargon, it's a Taylor rule is the term. But effectively, we're trying to minimize the deviations between inflation relative to our inflation target, which, as you know, is 2%, while keeping unemployment as close as possible to the natural rate. The first is more important than the second because we have a hierarchical target. So there is a mechanical rule which drives the response. Now, if I may, your questions about the order of magnitude of, in some respects, it's about the order of magnitude of rate increases. Said another way, it's entirely natural in a situation, or can be expected in a situation where inflation rises above target, that interest rates may well be higher than otherwise in order to bring inflation back to target. The issue in the stress test is that we introduce a risk premium on UK-based assets, and so there's in some respects there's a behavioral response of financial markets on not just UK assets but a broader risk-off tone to markets that persist. So if I can just recap, there's a fundamental shock in China, in fact an outright recession in China. There is a broader global slowdown that cascades through to the United Kingdom. There are large misconduct costs on UK assets. All of that works to, in in conjunction with a fall in sterling to slow the UK economy, push up inflation quite substantially, and interest rates respond to bring inflation back to target. Now, there's lots of ways one can look at that and say, well, should the bank look through it, or would the order of magnitude of the shock be less? The point of the stress is that it is an extreme event. It is a severe event. It's a tough event, and we do that in order to make sure that the banking system can withstand something like this. I would add as well that the experience in the United Kingdom, and it's a full credit to the people here, is that the people of the United Kingdom pay their debts. They pay their mortgages if they can, and including as much as possible, even if they're unemployed. It becomes very difficult, though, if they're unemployed and interest rates rise, and it was something that is done if it's necessary. But it's that combination: slower economy, unemployment, higher interest rates, that drives defaults, that drives the stress onto the banks. To bring to the bottom line, though, what it means is the banks are well capitalized for that extreme event, which means that as we sit here today, and we're talking about the Financial Stability Report, we can talk about risks in China, risk globally, risk closer to home. It means that the financial system, we have confidence, say individually, but I believe as a committee, we have confidence that the system is, at the core of the system, is resilient to the types of shocks we could see.
Okay. That covered quite a lot of what I do want to ask you about, but actually I do want to challenge some of the, and I appreciate they are mechanical processes that arrive at the outcomes. But the stability report itself says the assumed rise in bank rate to 4% in the stress helps banks to widen the gap between what they're able to earn in interest on loans and what they're required to pay out in deposits, which is what you've said, to ensure that the banks are sufficiently capitalised. But the high interest rate is obviously very helpful to the banks. And given, I guess, is there a concern that that is why it's been included in the stress test rather than it would be the mechanical response to those events?
Absolutely not. In fact, we've done a number of stress tests over the years now, some with falling interest rates, some with rising interest rates. And the reason for that is because the interest rate effect has these two sides to it. One is the one you cite, which is as interest rates rise, at least from current very low levels, banks are able to expand their net interest margin, and we document that in the report. But the other, of course, is the one the Governor mentioned, which is that rising interest rates lead to more impairments on their credit books. Yeah. The net of these two things for the banking sector is that higher interest rates are generally overall bad for the banking system in a circumstance like this. The impairments effect outweighs the net interest margin effect. And so that's another reason that it makes the test actually tougher to put those higher interest rates into the scenario. And as the Governor said, we make no apology for how severe the stress scenario is. We saw 10 years ago the cost of having a banking system that wasn't strong enough to survive a bad economic situation. Now, partly because we've been doing these tests, we have a banking system that's more than strong enough to survive even this highly unlikely but still plausible economic scenario. The big thing that's changed over 10 years, and there's a chart in the report that documents this, is quite how far the capital base of the banks has built up over time. This is a stress test in which the scenario is, in some respects, tougher than the financial crisis. The loss rates they incur, are pretty similar to the financial crisis. They make 100 billion of losses on their loans and trading books. The difference is that whereas 10 years ago those loss rates made 200 billion of losses and they had 100 billion of capital, they made losses twice their capital base. Yeah. Now they make losses half their capital base. So they have more than enough capital to survive a circumstance like this, which means that even in a very difficult economic situation, the banking system isn't the contributor to making it worse. The banking system can be an absorber rather than, as it was 10 years ago, an amplifier of the effect on the rest of the economy.
Yeah, I mean, I do appreciate that, and that's a helpful explanation. But I guess one of the concerns is that even if the banks have the capital reserves to lend, the scenario that you describe, is there not a concern that they wouldn't necessarily do so? I mean, are they going to be lending to companies, to house builders, when there's serious economic turbulence and headwinds?
Well, I was going to say, I mean, remember, they're in business to make money, and the reason they wouldn't lend is because they wouldn't have enough capital to expand the balance sheet to meet these needs. There'll be lots of people asking for money and businesses asking for money in that kind of a scenario. And the worst case, from our perspective, is they don't have the balance sheet resilience to be able to grant those loans. So they want to lend. I mean, they wake up every day wanting to make money, and that's the way they do it.
But the issue is, would they be making money? I mean, if we have high rates of unemployment, are they going to be happy to lend to households? Are these very high? Is this much more high risk lending? And obviously, they will make money from that, but there's also risks as well.
Yeah, the issue is that we need to put them in a position where they have the ability to lend. And lend in size. And then the demand for loans is determined by households and businesses in the country. And I mean, I think as we all know, in a downturn, in a recession, people buy fewer houses. Businesses tend to, at least initially, invest less, pull in their horns, write their balance sheets, and then they expand. But what we are looking to avoid, and we are confident we're in a position to avoid, is that the financial system makes that worse. Because what happened post-crisis was a dramatic illustration of this. But I tell you, this can happen in other jurisdictions to a lesser extent, but a still significant extent, is that the banks couldn't lend. Yeah. And so people, young couples starting out, they should have been able to buy a house, couldn't get a mortgage. People with a good idea for a business couldn't get financing. Businesses couldn't expand because our system wasn't working. That's not going to happen. Okay, that's not going to. We are highly confident about that. But that is not the same thing as saying that there's going to be very strong credit growth if an event like this happened, because fewer people will be looking for that. Can I make one other point, though, which is that one of the consequences of this stress test is we as a committee sit and determined what the level of something called the countercyclical capital buffer is. And we have raised that gradually over the course of the last 2 years. It's now at 1%, and that binds. That is something that we can take a decision to release in the event that there is a downturn. That gives the banks more room to lend, and there's in the case of a 1% buffer, that gives them about £11 billion more of capital to support lending. Theoretically, if you gross that up, that is about 4 times the size. 11 billion grossed up, 250 billion of capacity is 4 times as much lending took place in 2018 in the UK economy. So the system has been set up, so there's a lot of capital, but they can use that capital, they can use these buffers to meet demand. Then the question becomes how much demand is going to be. Yeah. That is determined by other factors.
Okay. And have you stress tested those other factors?
So the other, let me answer that a slightly different way. One thing, so you have focused on, rightly, started with where interest rates went, and then went through the channel of what that does to profitability, and Mr. Brazier gave the balance of actually they lose more on their loans than they gain on the interest. Another type of stress would be to say, let's imagine a deflationary scenario where actually interest rates go down, and that the banks don't make that extra margin on the loans that are coming good, but also the economy slows into a recession because of deflationary factors. That's what we did in 2016. And so we have looked at this from a variety of ways, and we will continue to vary the scenarios in order to isolate certain potential vulnerabilities in individual bank business models or the sector as a whole to make sure that they're resilient to a range of shocks.
Okay, I mean, and you're confident that, I mean, I know you say you tested that scenario in 2016, you've tested this scenario. Are you confident that, and as you said, the demand in the economy will depend on other factors. I mean, you haven't specified what those factors are, but presumably you, which is a question I asked, have you
cascades through emerging markets and more broadly through the global economy. There are other big factors as well. So some of the factors are determined. I mean, this is a very open economy, so what happens to global demand? What happens to balance sheet repair, whether it's for households or businesses? Yes, government policy can play a role, but it's the core drivers, more often than not, are the real drivers, real demand, businesses creating new ideas, different investment, demand from abroad, innovation, competition. Those will be the drivers. Obviously, we play a role in helping to stabilize. The government does as well, but it's not just what is the policy setting that writes things.
No, but you've stated that these responses are and demand remaining in the economy, because this relies on demand remaining in the economy.
But it's important to have an internally consistent scenario. We wouldn't want to assume that the demand is collapsing when people aren't losing their jobs and when the economy's growing. So we have to make sure that this whole thing adds up and that we're not confronting the banks and their lending decisions with a scenario that's completely implausible. So we think of the demand as emerging in the scenario based on the other assumptions we make, where we're using traditional, patterns in the data, historical evidence to say if this was to materialize, this is a reasonable assumption for what demand would be. I mean, we can't know for sure, but we have to make sure that it's not way out of line with what would happen given the assumptions that.
Which is how this links into investment decisions by, let's say, SMEs.
Yeah.
If you look at the post-crisis environment, well-run SMEs were then facing refinancing risk, and with uncertainty because the banking system wasn't adequately capitalized, they were concerned about the availability of refinancing and the price of refinancing. That impinged on investment decisions and was, if you like, a negative pro-cyclical phenomenon. What this process does is capitalize the banks so that the SMEs themselves and some of the medium-sized companies can feel more confident that the banking system is open and available. That can flow back into them then continuing to make investment decisions, which they wouldn't have done otherwise.
Ms. Brady, did you have anything you wanted to add very briefly? And
just on the previous question, I don't think we're reliant on, as you put it, demand increasing in the economy, as you started out.
Maintaining.
This is a situation in which GDP is falling, unemployment's rising, house prices are falling. Demand is falling a lot in the economy. What we don't allow is the banks to assume that they could pass this test by simply restricting credit to the economy. We want them to pass this, to have the strength to pass this test without doing that. And that means, on the basis of the international evidence, and as the Governor said, we can be confident that they wouldn't do what they did 10 years ago, which is to be forced into a position where they have to cut lending. The international evidence on this is quite strong. Banks only really cut lending when they have to survive. And they did it 10 years ago because they made 200 billion of losses on 100 billion of capital. They had to cut lending.
I know you want to move on. I just want to make one other point important, which is that, and also what happens internationally, and we don't want to have happen here, is that you go into this recession, and then the regulators, us, tighten policy. and then that's pro-cyclical, and it makes it harder for the banks, and so everybody pushes in the same direction.
We're going to move from domestic to the global economy. So, Colin.
Yeah. You've already alluded to it. So 2 weeks ago, Apple issued its first profit warning, or its serious profit warning since 2002. So it's been largely because of growth in China. Is a downturn in China on the horizon, or is it merely lower Chinese growth? Make a prediction.
I'd say that there are a variety of indications that growth momentum in China is slowing. It's just been decelerating over the course of the last 12 months, and probably is going to decelerate further during this year. Chinese authorities have responded. The central bank has made a number of easing measures, including over the course of the last month. There are a few things going on here. One is, again, a real effect, which relates to the trade tensions, particularly with the United States, and that's introducing some caution on the corporate side, less business investment, and actually we're seeing in the now published trade numbers, the Chinese trade numbers came out yesterday, that there appears to have been a pulling forward effect in trade. So there were more exports before the tariffs came into effect, imports, and now there's a fairly sharp adjustment in trade in the most recent numbers.
And how exposed is the UK economy to China?
Could I make one other point, and then I'll get to that, which is that the other thing that's important that's happening in China, it's necessary but difficult, which is that they are reforming and reining in their shadow banking sector, which has provided a tremendous amount of support to that economy over time, but also raised risks. And what we saw in 2018 is that the reduction in lending in shadow banking pretty much offset the increase in lending in the conventional banking sector. So credit conditions there have tightened. That's why the bank has reacted. Look, in a direct sense, UK exposure to China is relatively modest, single-digit trade exposure. Indirectly through China's impact on global supply chains and global demand, it becomes more important. We have very large and welcome financial exposure to China through some of our leading banks have some of the largest operations in Greater China. And that's one of the reasons why we, and Mr. Clark, if I can put it in these terms, just quickly to go back to the stress test. So we're talking about a deceleration of Chinese growth from the high sixes through 6.5 down to low sixes, potentially into the high fives. That's material for an economy that is now 15% of global GDP, and we feel the effects. And it's one of the reasons for a broader global deceleration that appears to be underway, one of the reasons. But in the stress test, we don't go from 6.5 to 6 to 5.5. No, we go from 6.5 to an outright recession, negative 1.2. So GDP actually falls in China. And then there's that impact that cascades through the bank balance sheets in the UK, but also through the global economy.
Sort of the number that we have is that a 3% shock to Chinese GDP would reduce UK GDP by 0.5%. And in the most severe version of this, where we have a 10% shock, we can get that up to maybe a 3% loss. 10% shock in China would be cataclysmic. So,
but that underlines the whole point of the stress test, that it is a stress test,
and
as opposed to a prediction.
As opposed to a prediction. So
likely.
You're asking me for a prediction, and may I just add one other thing in terms of the numbers Dr. Kashyap just referenced. In order to get those types of numbers, you don't just have the real effect of Chinese growth slowing. Mm-hmm. You have an impact on global risk premia, financial markets, financial conditions here in the UK. In terms of expectations, we do expect the Chinese economy to decelerate. I should caution here that most recent forecast for China is of the MPC in November, and we will update in February. But on the evidence, I'll give my personal opinion that I would expect that Chinese growth would move towards the low sixes this year. In many respects, the markets have anticipated that. I know the Chinese authorities are aware of the softening, and that's why they have put in place some considerable stimulus. One caveat: stimulus in an environment when you're reforming a large part of your financial sector doesn't always pass through directly to the real economy.
So moving on from that then, is global debt vulnerability in China and Italy, for example, is that a bigger threat to the UK economy than Brexit, considering some of the predictions and suggestions that have been made? Anybody else can dive in if the government doesn't want to.
Which form of Brexit? Which
crystal ball stuff?
Which form of Brexit today?
I think you've got to look at tail risk events, which we capture in our stress test, versus present issues, which is obviously an issue for the Brexit is a present shock issue. What we are concerned about now, obviously, we watched very closely when Italian 10-year yields moved up to 350, 360. They're now about 280. So, but when they're moving up to 350, that was a potentially present real vulnerability, given the public sector debt there being 130% of GDP. We monitor it carefully, and we took action at the time of the euro crisis in terms of looking at the exposures that the UK banking system had to the eurozone, and that leaves us comfortable that the kind of tail events we're talking about are well covered by the capital in the system.
10% of their capital exposed to Italy.
I would just add that they're both very important. So when you look at our stress test, it's got both in. It's got the governor mentioned this earlier. We have a deep China slowdown, or an outright recession, and we have a shock in the UK with rising risk premia, closing current account deficit, which I may come on to later. By stress testing them both, we can ensure that a banking system that has half its exposures in the rest of the world and only half in the UK is resilient to shocks wherever they arise. So we don't really rank them. They're both very important, and we stress test both of them.
And on the internal consistency, because Germany is so exposed to China, when China shows that in our scenario feeds into the German situation as well.
So is there anything more that the Bank of England could be doing or should be doing realistically to make the banking sector more robust in the face of the global debt vulnerabilities? Or are you saying that we're already very well placed?
Well, I think let me give an example, which is that, and we may come on in more detail, so I'll just give the headline, which is that one of the things in the Financial Stability Report, one of the focuses of the committee over the course of the past year has been the rise in global leverage lending, the rise in leverage lending in the United Kingdom. And so we have done a detailed analysis of this to assess how exposed is the UK banking and broader financial system to this, and what could the impact of that be on ultimately the knock-on effects and ultimately global impact on the UK economy. And I won't go into all the details, others may want to drill down. It's revealed, but we have determined that the UK core financial institutions are one of the least exposed to leverage lending, and there's a very useful, I don't have the page number in front of me, but useful chart in the report which captures that. One of the least exposed, but in any event, what we have done is stressed their exposures to anywhere from 10 to 22% loss rates, depending on the nature of that exposure, well above what happened in the crisis, to assess the robustness of their capital positions. So, and my point, that's a specific, the general point is, our job is to continue to refresh our analysis and look for issues that are emerging, because it's when you think you've done everything you need to do is when the risk is building.
If I may just add one further general point building on that. The point of macroprudential policy is to ensure that the regulation keeps up with the way the world is evolving. And over the past few years, we've been in an environment where the global economy has been actually very supportive to growth. The level of UK GDP is because of this, about 1% higher than it would have been otherwise. But that's a period, as so often, when things look good, that's when risks are building. And so during that period, we've been making sure that we've been responding to those building risks. The stress test has got tougher in terms of China, as debt levels there went up. And the test has got tougher on the United States as corporate debt levels have risen as well. So the loss rate banks are incurring in the stress test has been going up. And the same for emerging markets. So as things have been developing, we've basically been making our tests tougher. So when times are good, normally people respond by thinking, oh, things are less risky, we need to do less. Actually, the point of macroprudential policy is to flip that on its head. And that's one of the things we've been doing through stress testing. So while times look good and risks were building, I think the phrase is we were fixing the roof while the sun was shining.
So on one of those huge risks, protectionism, how could the UK's banking sector and economy be affected by increases in global protectionism? I know the Governor's given evidence on it before. Well, you can carry on it. Because you were speaking about the macro risk.
Yeah, I would say two things. The first is about the central outlook for the global economy, which is obviously affected by protectionism. So far, the effect, as far as we can tell, has not been great, but the effects, I think, as the Governor laid out in a speech recently, could be bigger. But also, as the Governor said just now, that's, at least within bounds, a central outlook issue. It's an issue about whether the global economy slows from one path to another path that is different but not completely different. The issue for us is whether something like a slowdown in growth could play into the other vulnerabilities that have built up, like, for example, debt levels in China, debt levels in the United States. If those economies experience any slowdown on the back of increased protectionism, there's a question about whether then you play into debt levels becoming less sustainable, households, companies, governments in some cases needing to deleverage, and that amplifies the shock. So for us, it's not so much about, as the Governor described the China issue, it's not so much about the central outlook, it's more about whether those things could play into the debt vulnerabilities that we've identified in the Financial Stability Report.
So has the UK been impacted so far by the tit-for-tat trade war going on between China and the US? What should we be looking for in the economy, or are we? Because you said back in July, Governor, that the direct effects to the UK are relatively modest.
Yeah, so this is one of the things, is that to the extent to which the trade war is isolated, so it's between the United States and China bilaterally, third countries are relatively unaffected, provided there's not spillover through to financial markets. And in some respects, we have seen spillovers to financial markets in the latter part of November and through December. Some of that has come back as there's been a little better news or interpretation of better news on the trade negotiations there. So it's important what happens in financial markets. There is the possibility over time of some trade diversion to those third countries that are not directly involved. So to some extent you can benefit from it. Of course, that doesn't happen overnight. You need to have the capacity, you need to fit in to supply chains and others. The modeling that we've done has suggested, again, and, heavy grain of salt here, but to the extent to which it is a bilateral dispute, then the direct effects on the UK are relatively modest.
And are you optimistic that that dispute is reaching some sort of conclusion, or?
Well,
I don't read the President's tweets, but where are we?
Well, it's hard to say. I mean, it's because they are, the core negotiations are not being conducted in public. I would observe that the
President thinks they are.
Well, there are some in public and there are some in private, but the dispute has shifted from the early stage when it was began around overcapacity and in steel and aluminium to much more fundamental issues, if I can put it that way, around intellectual property protection. And effectively a range of broader issues around the trade and investment relationship. If I can just finish the thought, which is that I guess I would caution that type of dispute or discussion, maybe put it more positively, discussion, is the type of thing that where it is possible that it will be an ongoing series of discussions, and there may be progress on a specific arrangement, but these more fundamental issues will take some time to have a meeting of minds about, because the two sides start from very different positions.
If I can add one thing, which is we shouldn't overlook the capital flows. We need to finance our deficit, and we have been a beneficiary of Chinese foreign direct investment. And so clearly, as China's demographics change and they move into a more savings country, plus given their overseas holding of foreign currency assets, a good cross-border activity should also encourage better capital flows, and a portfolio allocation to the UK is quite significant in reducing our cost of capital.
Okay. That was one of my other questions. Chair, I will hand over.
Thank you. We'll come back to the current account deficit point because I think there was more to say on that, but I'm going to bring Simon.
Yes. Thank you, Chair. And we touched upon leveraged corporate loans, and it is indeed now time to drill down a bit more into those, because obviously that is, you can hear the ghosts of subprime mortgages clanking their chains when this topic is brought up, and it's relieving to hear that the UK is less exposed than some other jurisdictions, or most other jurisdictions. The FSR explains that a share of loans where investors do not require borrowers to maintain certain financial ratios has reached record levels. Borrowers are also increasingly indebted. There has been growing use of adjustments to how earnings are calculated at the point a loan is made that assume potential future earnings as investments are realised, which may overstate EBITDA and therefore understate leverage. That does sound pretty seriously like the subprime crisis. How concerned should we be?
Well, I think we are concerned, which is why we've spent a lot of time on it, and commend you for actually quoting that part of the report, because this is very clear evidence of a steady decline in underwriting standards. You have all the hallmarks. Once you start adjusting cash flow, which is what so-called what happens in financial history is they come up with a new term for these types of adjustments. The term of art at present is add-backs, and there is a chart in there which gives a sense of the scale of add-backs, but they're quite substantial add-backs to underlying actual cash flow, which adjusts for future events that whether it's synergies in a merger or cost cuts or other things. First point. Second, we're now up to, I think, 80% of covenant light. So drifting again, to keep with the subprime analogy, which isn't perfect, but just to keep with it, is on the road to no doc underwriting, which happened 11 years ago. It's also concerning. One of the protections that we have in the UK is that if you securitize a loan, so you originate the loans, you securitize, and you sell it off, there is regulation here, which is European regulation, but it's, we would retain it, which requires you, the originator, to retain a portion of those loans, so to have skin in the game. That had been the case in the United States. It was struck down on a legal challenge about 18 months, 2 years ago. So they've now lost that incentive alignment. So we are concerned, and we're also concerned just because the scale, the pace of growth has been quite rapid for some time. And if I can again go back to the subprime analogy. Subprime, which was a form of financial inclusion when it originally began and brought lots of people into the housing market, and originally was quite a good thing. Yeah. It was when it kept growing at double-digit rates, when underwriting standards kept deteriorating. So once you got to 2006 and 2007, that's when virtually all the damage was done. Those subprime underwritings were really poor. And so when you look at something like the leveraged loan market, you get worried that latterly in trouble.
And are we at that stage of the cycle?
We were getting to that stage, which is, again, I think why the FTC is focused on. And an increase in in leveraged lending was happening in the United Kingdom. Mm-hmm. Okay. So just, and then I'll hand to Mr. Sharp. So what we have done is we have, and I won't go through all the numbers, but we have dimensioned the exposure of UK banks to this. How many CLOs do they have? How much do they have in the pipeline? How much do they have on their books? We've applied various loss rates through the stress test, and we stressed them harder than in the global financial crisis because the underwriting standards have gone down, and we're satisfied. But also there's supervisory guidance on top of that. But
if I can put a slightly different spin on it, just very slightly. First of all, leverage lending properly executed is a good source of capital, and also it's an important source of profitability to UK banks. London is a European centre of leverage lending. So the issue isn't that leverage lending shouldn't take place. Leverage lending typically is defined as 6 times EBITDA.
Right.
When large corporates take these loans, they often put interest rate protections in there, so they are protected. But obviously, as the Governor said, there can be failures in terms of judgments about future profitability.
Yeah.
But 6 times EBITDA gives a substantial amount of coverage in current interest rates.
Yeah.
The other point I'd make is it's not surprising to see leverage lending growing, because if we go back 5, 6, 7 years ago, there was much more doubts about interest rates. We've had lower for longer, and therefore it's a significantly lower cost of capital. So I just want to put in perspective, it's not just all bad, it's a source of major employment and profitability here. It lowers the cost of capital for investment. The issue is it should be well managed and carefully managed, and the bank's capital should be appropriately matched against their risks.
On that point about careful management, Mr. Brazier, on numerous occasions in the FSR it says that figures are based on bank staff estimates in terms of where the risk lies, and that's obviously pretty integral to actually managing this whole phenomenon.
That's right.
Why are you having to rely on estimates, and does that suggest you don't know fully who holds these debts?
We did not know fully who held these debts, but as a result, as the Governor says, of observing something, or as you said, that has the ghosts of subprime jangling their chains, we did a pretty thorough deep dive. Now, the fact that we had to do the deep dive is indicative that no one else has put the numbers together. But we felt the need, given what we were observing, to actually put the numbers together. Interestingly, our counterparts now in other jurisdictions are consumers of that. They're very interested in what we've put together because it's the only, as the Governor referred to on page 45, the so-called waffle chart that breaks down who holds these packages of loans, of leverage loans. We are the only people to have done that. Now, that means we've got a much better idea about where these loans are than we did, say, 6 months ago, and everybody else does too. For some people, that should our conclusions should ring alarm bells. For us, they actually allowed us to be moderately reassured about UK banks' exposures, which we've been able now to stress test fairly thoroughly. I would just add one other point, though, which is that unlike the subprime episode, it's clear when you can at least find the data that who holds the exposure. So an issue with subprime was that on the face of it, it was off of banks' balance sheets. But actually, in many cases, it wasn't. It was in a off-balance sheet investment vehicle, a SIV, that was funded by the bank, and when push came to shove, it all came collapsing back to the banking system. One of the things that's different here, partly as a result of post-crisis regulation, is that we don't have that shadow banking. Where this is held in banks, it's clearly held by banks, and you can manage that and stress test it. Where it's not held by banks, it's held by hedge funds, investment funds, other sorts of funds, where the risk is on their balance sheet, and they're more able to absorb it. And that's one of the big differences, I think, with subprime. Even though the growth rates look the same, the underwriting standards have some disturbing similarities.
Investors for these products. And of course, the mere fact we're having a discussion like this today may be part of the process why some people start thinking about whether they are such a clever thing to be holding on the scale that they're holding them. What does that risk to both the UK and the global economy?
Well, I think let me start from a UK economy. First, a readjustment of, and there has been some readjustment in the, about a 70 basis point on average readjustment in the spreads for leveraged loans in the last 2 months globally, including here in the UK. And that it's probably directionally right, and it's not. But that is a market that is still functioning. There's issuance, and that is welcome. And I certainly associate myself with Mr. Sharp's comments about the value of the market as a whole. In terms of the UK right now, there is not, at present, there's not deep demand for corporate borrowing, given the temporary uncertainty. First point. Second point, UK corporate balance sheets have re-levered in the last few years, but they're still in pretty good position, particularly from a debt servicing perspective. So when one looks at their profitability relative to their interest and principal repayments, they're still in a reasonable place. So to put it in a bit forward-looking position, our sense would be, maybe I should personalize it, my personal sense is the market's undergoing an adjustment, there's greater focus on underwriting, that's healthy, as greater certainty comes to this economy through your process, good UK corporates will be in a position where if they're lower investment grade or sub-investment grade borrower, they'd be able to access this and help grow this economy.
Does anyone else want to supplement that?
Well, just back to the leveraged loans. I mean, the thing that when the committee first started talking about this, we were quite worried about the pipeline risk and what would happen if the appetite dried up and they weren't able to place these things and had to take them onto their balance sheets. We've dimensioned that. The numbers are pretty modest. And importantly, there's almost no wholesale funding behind any of this. So the odds of getting stuck with something where your funding is running away is another difference vis-a-vis subprime.
But final point, just to give you some reassurance. So in looking at that pipeline risk, the loss rate we applied in the stress test was 22%. So if bank got caught underwriting something that they ultimately, that's
pretty high.
That's very high. It's higher than during the financial crisis. Yeah. We took the higher end in part because of the deterioration in underwriting standards, but it's a pretty severe, tough number. So that gives us some comfort.
That's really helpful. Thank you very much,
Steve.
Governor, I apologise. My failure to send you a Christmas card was entirely part of a general failure. So thank you for your Christmas card. I can announce you are on my Christmas card list. I'd like to turn to the
apology accepted. That is a tremendous relief.
Well, you're all on my Christmas card list. So, but thank you very much. You're a generous note too. But I want to turn to the capital treatment of sovereign debt, because you'll all know that the government's no-deal plan is to remove the preferential zero rate on European Union sovereign debt. Can you tell me, was that an FPC request, Governor?
To remove? No, we did not. No, we made no specific request regarding the adjustment of the risk weighting. That is a mechanical consequence of leaving the European Union. I would add the caveat, which I suspect you know, but just for the record, is that it becomes relevant. It's relevant for sovereign debt that's rated below AA minus, the equivalent of AA minus. So to put a point on it, for the reverse into Europe, provided our ratings are recognized of gilts, and the United Kingdom is rated AA flat at all of the agencies. So you're not necessarily asking this question, but it would not apply to the United Kingdom for European holders of UK gilts.
Well, that's most helpful. Do you think it helps or hinders the work of the FPC in setting capital requirements to have this, as you put it, mechanical removal of the zero?
Well, I think if I can go first to the theoretical, colleagues may want to jump in, but the point of having zero risk weighting on sovereign debt is within one's own currency, principally, and sovereign debt is risky, just like any other type of debt. It tends not to. It is less risky in your own currency, for reasons we can get into, and reasons you don't fully support, I suspect. So the holding of foreign sovereign debt, foreign currency sovereign debt, having some risk weighting is sensible. It's not something we asked for, but is something that would be consistent with prudent risk management. At some threshold, it becomes less relevant.
I mean, you mentioned the word mechanical. I mean, the application of law, of course, should be mechanical. It's part of the point of the rule of law. But we could have a different choice in our rules, couldn't we? We could choose to zero rate European sovereign debt if we wished.
We could do. There is, as you know, there is a wide range of riskiness of various European sovereign issuers. So, okay. From a prudential perspective, it's not necessarily desirable. And I would add further, if I may, that there's a question of the capital charge applied, but there's also a question of concentration limits and other things that if there's one can introduce real distortions. People can risk up because they think a certain sovereign is much more creditworthy relative to its rating, particularly if they don't have to apply any capital. And now I'm really stretching the analogy, but I appreciated the previous exchange on leveraged lending and subprime to remind what happened in the past. Well, what happened in the past is that so-called leveraged super senior, the bits of, that the civs would buy, the so-called they were AAA, top of the credit stack, was very low, had very low risk weighting, which is precisely the kind of situation, and people loaded up on that. And then they found out it was much riskier than it appeared. And that's the kind of situation you can get in if you have these capital distortions, the kind of situation you can get into over time.
I want the stress test is a big innovation vis-a-vis 2007, because if we do the trading losses flow through. So if there's a increase in spreads because some country's situation deteriorates, if they've played off of the miscalculated capital charge, it's going to hurt them in the stress test. So that's one of the biggest improvements, I would say, relative to pre-crisis.
So could you elaborate a little, perhaps one of the external members could elaborate a little on what this means for the bank's capital requirements and therefore their robustness and resilience?
Well, I think the important thing is as long as we've got a global component to what our stress scenario is going to be, they're going to suffer losses, and if they had zero capital charge against it, that's going to drive them closer to the minima. So to the extent they understand that they have to survive one of these stress tests, that's an important constraint on how far they can load up on these things. So it's very difficult to know what to do with the risk weights. We don't want to go back to a world where the credit rating agencies can create risk by fiddling a one notch. Okay, so that's not great. You could try to use things like credit default swaps. Those markets are thin. I think our stress test, strikes a nice balance because we put this through. The losses that we assume are consistent across all the asset classes, so it doesn't look like it's discriminatory. And then we have to check that they can meet the standard.
Mr. Sharp, we've talked a little about, in fact, you used the term real vulnerability in relation to Italian debt earlier in the session. Do you think that there is a case that with European sovereign debt at this time that it is wise to have a positive risk weighting on their sovereign debt?
On their sovereign debt?
Well, any EU nation. To actually, rather than having a blanket preferential zero risk weighting, given that we're outside the Eurozone, given that the political and financial system across European countries is difficult, tricky, I think civil servants like to say.
Personally I do, yes.
Is there anything, bearing in mind it's your last session, is there any advice you would want to give the committee or indeed the FPC on this particular issue? The Governor is all ears, I think.
I have no unique knowledge. I just remind people, certainly if I look back at my career, when I started in finance, Venezuela was AAA. And so things change.
Yeah.
And the Governor on my right has spent a lot of time on analysis in his private sector work on sovereign risk. And and then if you look at the global debt environment, it's salutary to bear in mind that global debt to global GDP is higher now than it was before the crash. And a lot of the burden of that has been borne by the sovereign level. Take China, we were talking about. China in 2008 had non-financial sector debt of $8 trillion. Since then it's gone up by about $25 trillion. It's now about $33 trillion. So it's hard to... So some of the numbers are quite significant, and obviously some of the debt to GDP numbers are significant. And if we're entering a regime of lower global growth, which is one of the sources of sovereign creditworthiness in terms of their tax base, that clearly is a challenge over the next 5 to 10 years for certain sovereigns.
isn't this enormous expansion of debt a mechanical consequence of the policy choices which have been made to try and deal with the global financial crisis?
Well, I think you've also got to look at the reduction in poverty in countries like China as a consequence of their growth. They've contributed 27% to global growth. We've got not just one engine of growth in the US. We have another polar growth in China as well. And whilst there are correlations, the fact that they're differentiated is very good for the global economy.
Briefly, I think big picture, yes, I would agree with your characterization, and I'll make a couple points. One is that one of the things with financial crises is, in the end, this is history, has been that the costs are borne by the taxpayers. And they're tremendous, and they're borne over a long period of time. And so the losses of the shareholders get either explicitly bailed out, the shareholders and debt holders explicitly bailed out by the taxpayer, and we've seen examples of that in this country, other countries, or the fiscal cost, the hit to the budget deficit, whether it's through automatic stabilizers or actual proactive fiscal policy to lean against the recessionary and in some cases depressionary, if that's if I can coin a phrase, word, effects of the collapse of the financial system. That is borne over time. And so both of those combined are measured in, are driving this extraordinary increase in debt. I would make two points related to that. First, that's why we're spending a tremendous amount of time on ending too big to fail, so that this process is quick, clean, and centered on the private sector and centered on those who have supported the activity of the institutions, and making sure that they recognize it and align it. One thing that happens in our stress test, it's a little thing, but it's part of a bigger picture, is that some of the holders of so-called AT1 securities get bailed in the stress test. That's what's happened in the last few years. And so they learned that actually they thought they had a guaranteed debt stream, but actually they become equity holders. That should not be news to them if it happens to them in the future. Specs, and in hindsight, a replay of what happened in the United States with SIVs, off-balance sheet vehicles of banks driving, and that's driven a lot of that debt increase in China.
Conscious of time, a final question. How does this removal of the preferential treatment of EU debt, how does this affect the bank's competitiveness? And I suppose a second point, what will it do for the demand for UK sovereign debt?
Well, quickly on the second, as you know, we intend to retain our rating, if not improve our rating. So as long as we're AA and above, the consequences of the measure don't bite. It's important, by the way, this is a narrow plumbing issue, but it's important that the ratings, not just of the UK government, but also of UK institutions, are recognized by the EU in the event of no-deal Brexit. I alluded to some plumbing-type issues that still have to be brought over the line. That is one example of them. We're working on it as a plan. There's, but it's got to be brought across the line prior to Brexit Day. Competitiveness in terms of holding government debt for investment purposes is not a big deal for banks. If you're relying on that for your competitiveness, you're probably in trouble. And the nature of market making and trading is much more inventory light, which is a good thing. So yes, it's there on the margin, but it's and final point, longer term, applying risk. Or assessing risk appropriately and having capital against that risk helps make you competitive for the medium long term.
Unless anybody else wants to come in, I'll say thank you very much.
Thank you. Thanks, Steve. I just want to return to the issue about the current accounts deficit, which I think, Mr. Razier, you referred to earlier on, and the part of the report that looks at that. And the report says, looking ahead, the ease with which the current account deficit is financed will be influenced by the credibility of UK macroeconomic policy framework and continuing openness to trade and investment. And perhaps you can just unpick which potential UK government policies could make the current account deficit harder to finance.
Okay. Let me start with one important piece of background, though.
Okay.
UK current account deficit, 5% of GDP, biggest in the G7. We are reliant, as I think the Governor said a few years ago, on the kindness of strangers.
Well, that has been disputed, so we might come back to that.
We'll come back to that. I'm firmly behind it. to mix my cultural metaphors, when we talk about the kindness of strangers, we are not tilting at windmills. The point is the current account deficit has been financed by capital inflows from abroad.
Yes.
60% of that over the past year can be on net accounted for by people buying UK commercial real estate and buying leveraged loans issued by UK companies, as Mr. Clark alluded to earlier. So those have financed, if you like, the fact that the UK overall is spending more than it earns.
Yeah.
For that to continue, we need to rely on the risk appetite of foreigners for buying things like commercial real estate, corporate debt, and other things. Now, it's not difficult to imagine a number of things, both external and internal, that could change that risk appetite.
Let's concentrate on the internal.
Fine. So I would say a number of things, and they're all captured in the stress test. The first is, of course, question marks about the UK's free trade agreements or free trade policy in the future, where the issue there is that depending on our trade arrangements, the sustainable current account in the future could be much lower than it is today. If you look at our estimates of our sustainable current account today, that's the level of the current account that doesn't result in our net international investment position deteriorating over time, they are a bit below, but not far off 5%. If you change those trading arrangements, and for example introduce tariffs and non-tariff barriers in the way we do in some of the scenarios in our response to this committee, the sustainable current account deficit falls considerably. To get there, you have to have a period of adjustment with funding costs for the UK rising, the exchange rate falling to crowd in net exports, but saving rising and investment falling. That's a painful adjustment. Ultimately, the UK has the mechanisms, a flexible exchange rate, to make that adjustment, but getting from A to B is not straightforward. And so one of the things, as the Governor mentioned earlier, in our stress test is exactly this. It's foreigners losing some of their appetite to invest in UK assets, and as a result, funding costs rising for the need to put these sorts of things in our stress test scenario. We don't try and forecast what the precise trigger for such an event could be. We just ask ourselves, as with so many things, the question, could it happen? Is it possible to imagine it happening? The answer is yes, and that's why it's in the stress test scenario.
Could I, just quickly, one other sort of institutional point, if I could make a short commercial for the Bank of England and the Monetary Policy Committee and monetary independence and commitment to low, stable and predictable inflation. And it's a serious point. The predictability of the macro financial policy regime is one of the determinants across all countries of the sustainability of inflows. It's not the only one, but it is one of them, and it's one of the reasons why it's one of many reasons why the UK is an attractive destination.
Okay, so let's talk about, because also that attractive destination has been cited by many as a good thing, and that looks like people are still wanting to invest from overseas in the UK. But I think the report noted that over the period 2012-2015, the current account deficit was financed by UK investors selling overseas assets at a faster rate than foreign investors selling UK assets. That position has reversed since 2016, so foreign inflows have been substantial, which I say is pointed to by some saying actually this is a good thing, people want to invest in the UK. What caused the reversal of that position in 2016?
It's difficult to say precisely what caused it at that point in time, and a lot of these things with the current account are very volatile, they have a habit of changing rapidly. But I would just highlight that while it's good that foreign investors seem to have had that appetite for UK assets over time, it is reliant on the things we've just been discussing, and the Governor mentioned the institutional framework in particular, but also it does create the risk that people lose that appetite at some point in time. You're vulnerable then. We are vulnerable. We are spending, as a nation, we are spending more than we earn. It's good that people are willing to invest, but that means the onus is on the UK to retain that attractiveness as a destination for foreign capital flows, unless we want to go through the sort of adjustment we just discussed. And the important thing for us is to make sure if such an adjustment were to occur, the financial system is resilient and able to deal with it.
Two points. One is a bit of the 2012-2015 period. Some of that was UK bank deleveraging, and so shedding of foreign assets there. So that was some of the element there. Secondly, in terms of the quality of inflows, one always gets a little concerned when a lot of something is classified as other. And in this case, 45% of the inflows to the capital account are other investment. Now, other investment, and one has to caution a bit with the data here. They do move around, but other investment can range from interbank borrowing, particularly short-term portfolio investment. So it tends to be in the hierarchy a little lower quality of an inflow and easier to repatriate of an inflow than, for example, foreign direct investment. What we've seen on the foreign direct investment side has been a shift from investment in plant and equipment to an investment almost exclusively in commercial real estate. And so a vast proportion of the majority of, for example, commercial real estate transactions in London Southeast are financed from abroad. 80 to 85% of leveraged lending is financed from abroad would be another example. So now it's not surprising, again, that there's less FDI into plant and equipment given the deliberations in Parliament and where the future is going, and for all the reasons why the UK is attractive, one would expect that to start up again once there is greater certainty.
So just finally, I mean, that means that the vulnerability to a property crash might be too strong a word, but a property. I think we've seen that the London property market has slowed down considerably. Any nervousness in the property market, that is a source of particular vulnerability. You're nodding.
It is a vulnerability, and again, I know we spent a lot of time on stress tests, but Dr. Kashef's point about the consistency. So one of the things is that as the current account in our stress tests reduces, fewer inflows to commercial real estate, bigger impact on commercial real estate prices. They're down by about a third in the stress test. Knock-on effect at the extent to which our banks have exposure. And by the way, it's not by the way, actually a central point. UK bank exposure to UK commercial property is at decade lows.
Right, okay, that's very interesting. And Wes?
Good morning, and I'm sorry I missed the first part of the session.
It was fantastic.
I've no doubt. I look forward to reading the written record.
Especially your evidence, Governor.
Absolutely.
Christmas cards.
I will. Now you've said that, I will actually watch it back, not just read it back. I cannot wait. But actually, I don't want to talk about Brexit. Instead, I want to talk about some of the concerns the TUC have raised about the levels of household debt. To begin with, I think the TUC analysis said that total unsecured debt has risen to 428 billion at 30% of household income. This is higher than before the financial crisis. Does the bank concur with those figures? And do you agree with Frances O'Grady when she says that household debt is at crisis levels? Maybe Governor, begin with you. Key to your views across the panel.
Well, first, I think welcome the TUC's analysis of this issue and profiling this issue, and the committee has focused on it in the past. Big picture, UK households have worked hard to pay down debt since the financial crisis. The overall level of household debt, so secured and unsecured, has gone down by almost 20 percentage points relative to income over the course of the last decade. And overall, again, and there are different cohorts, and I'm going to come to the specific question, the ability to service that debt, so the cost of that debt, repayments, interest and principal repayments relative to income, is actually now quite low relative to history, almost 2 standard deviations below historic averages. So, but there are cohorts. Now, there are some differences with the way we look at household debt, and sorry, to be specific, the TUC analysis looked at unsecured household debt, which is about 15% or so of the overall stock of 12% of the overall stock of debt. So they're looking at 12% of the overall stock. And they come up with a figure on a per capita basis, which is about twice our figure, so about £15,000 per head, and we're about 7,700, I think. So what's the difference between the two? 60% of the difference between the two is accounted for by student loans.
Yep.
That, say it right up front, student loan debt, lots of students or people who've graduated, we have lots of them working with us. It is a overhang on the individuals. As you know, as they get to certain thresholds, they begin to have to pay that back. It does affect their consumption. It has other effects. on those individuals. But it is not, from our perspective, strictly debt, because what it is, in effect, is an income contingent tax. As you know, once you get to certain thresholds, you start to pay it back. Then, in terms of the proportions, the next, they've included two things which we just wouldn't include, because one is, I think about 13% of the difference is lending to the so-called NPISH sector, which is nonprofit institutions, schools, and hospitals. Those aren't households, and just they've used ONS numbers that happen to include those in a bucket, but that's not household debt, unsecured debt. And then the third is lending from foreign institutions to households. And the reason we don't include that is that's just an estimate by the ONS. The ONS takes all foreign institution exposure to the UK and takes average exposures across various liability classes and just says, well, there's this percent that kind of should be for households. Mm-hmm. Since we go from the other side and look at actual balance sheets and exposures, they don't line up, but we're pretty confident by going to the balance sheet and exposures that way. So it's clear you take out, in our view, that. It's also clear you don't include the debt of nonprofit institutions, schools, and hospitals. Both of those are clear. You can have a debate about student loans, and we're doing some research on how that student loan overhang affects marginal propensities to consume and invest, but as a sort of longer-term project. But that accounts for the difference. If I could put it into the big picture, again, we're talking about 12% of overall borrowing. Last point, unless anyone doesn't think we look at this, we do look at this on a regional basis, and obviously from an age cohort basis. And so we're well aware that, for example, in the Northwest, the burden of unsecured debt is much higher relative to the national average, whereas in the terms of overall debt, the highest burdens of overall debt, because of the high price of house prices, is greatest in London and the Southeast.
That was very helpfully comprehensive, not least because you've now knocked out all of my questions on student loans and why the bank doesn't account in those ways. So that's very helpful. So all of that taken into, and actually, just on a slight digression, the work that the bank is doing on the impact of student loans on a whole range of issues, including consumptions, would certainly be personally interesting to me. Yeah. So I'd be grateful if you wouldn't mind sharing it when it's available. I'm sure it would be of interest to the committee.
It's early stage, but we will definitely share.
When you're ready to share something, that'd be interesting. I'll bring you in, Alex, but I can also just broaden out the question slightly. So taking into account what the Governor said about how the bank views this in context, in historical context, how concerned should we be about the levels of unsecured lending that's currently taking place and the risk both to households from the bank's point of view, but also the wider rest of the economy? Alex, I'll bring you in now.
Okay, thanks. 2 points. Firstly, we think, building on what the Governor said, the overall levels of consumer debt in the economy, around about 15% of household income, that is in line with its historical average. So once we strip out things like student loans, which, as the Governor said, very real burden, and we need to think about, in particular there, what the, if you like, income contingent tax liability that they create means for not just consumption, but also the ability to service other debts.
Yep.
So that's the financial stability issue we're going to focus on. And as the kind of graduate population that has been through this student loans regime increases, that issue will become more and more important, hence the importance of this work.
Yep.
But we don't think the level of consumer debt, as we look at it for financial stability purposes, is at an unusually high level. But it had been growing extremely rapidly, had been growing at annual rates of about 11% a year. That was troubling, not because it was necessarily a direct macroeconomic issue. The flows here are the flows of new consumer credit are about 1.5% of consumer spending, so they're not big from a macroeconomic perspective. Mm-hmm. The wider risk was that banks and other lenders were actually looking at the performance of these loans in the recent past, when write-off rates have been coming down, and thinking, oh great, our underwriting standards now must be excellent. These things are less risky, we can do more of it. And as a result, you saw interest-free periods extending, you saw interest rates coming down on these types of loans, and general supply conditions loosening. That troubled us because had it gone on too far, it could have compromised the resilience of lenders. This is an asset class that accounts for only 7% of their UK lending, but accounts for 40% of the losses they take in the stress test. That's because, in contrast to mortgages, which the Governor described earlier, people are much more likely, in the sort of scenario we've described, to get into difficulty and default on this type of debt. Because we saw that, we had a thorough look at banks' exposures, concluded that actually, even though write-off rates had fallen, that wasn't so much to do with the quality of the loans they were making and the credit worthiness of the people they were lending to. Actually, it was due to a relatively benign economic backdrop of steady employment growth and low but steady wage growth. On the back of that, we increased the losses they thought they would make in the stress. We increased the loss rate on these things from 13 to 20%, and as a result, the banks had to put aside £10 billion worth more capital against these exposures. At the same time, the PRA issued guidelines to banks about their underwriting standards, effectively to say, don't just look at credit ratings, please look at the underlying ability of the borrower to repay this loan. That's not just a conduct issue, that's a prudential issue. Now, who's to say whether it's coincidence or not, but at around the same time, the growth rate of consumer credit seemed to slow very sharply. It's come down from around about 11% of income, and the growth rate has now come down to more normal levels. Maybe that's due to our interventions, maybe it's not. But when it looked like it was growing rapidly, this was a serious issue for us, and we intervened.
Yes, and I think that's a point of consensus. Finally, then, just conscious of time. Just following on from the Chair's earlier questions around, I want to quickly ask about mortgage lending. So the FSR notes that the share of advertised products available to finance a 90% loan-to-value mortgage increased from 13.8% in September 2015 to a post-crisis peak of 17.3% in September 2018. How concerned are you by this trend? Is this something that we ought to be concerned about?
I think the loan-to-income guidance that we give is one source of reassurance. So we see some bunching right below our threshold of 4.5, and we think that that's indicative of the fact that the policy is kind of working. It's very important that we also have these affordability tests built into the mortgages. So while that credit's growing, we're accounting for it, and we're checking that the borrowers can support those levels of debt, and we'll be able to continue paying. And then, of course, our stress test checks. And as we know, even during the crisis, the mortgage losses were modest because people will do everything they can to keep their house and keep paying and stick with that. So it's something we watch all the time. It's why we have the housing tools that we've got in place, and I think they're working as we would have hoped.
Governor?
Yeah, I think two things. One, on a practical, from a constituent level, thing we're focused on, your constituents, not ours. Well, they overlap perfectly. They're across the country. But the point being that people who new first-time buyers, people who move to regions where house prices are higher, high loan to income, and high loan to value mortgages may be necessary, and maybe in most cases, a very sensible decision. Younger people who are going to grow into these mortgages, and so our first responsibility is financial stability, but we're trying to take into account these dynamics in the market and monitor accordingly. The second thing, though, is that we are conscious that, and this is also true of the very true of the PRA, that the housing market is slow. The amount of capital dedicated to mortgages has continued to increase, and that the process of ring fencing banks, ring fencing the domestic operations of banks, may be having some impact on competition in this market. In other words, banks with considerable capital, liquidity, and a deposit base that where maybe not the only game in town, but the principal game in town is mortgage lending, may be that could create dynamics where certainly banks are going up the risk curve, And the first thing we want to check on in that regard is, do the banks, their boards, their risk managers know they're going up the risk curve, or are they just sort of backing into it? And so from a supervisory perspective, there is greater supervisory intensity around this. What risk rates are they applying? How well is this being managed? So we're conscious of some of the competitive dynamics. I think just for openness, that is one of the things that is happening here. But we very much start from a financial stability perspective, from where Dr. Kashyap was in terms of the protections that have been put in place.
Thank you.
Thank you. John.
Well, good morning, and in these turbulent times, you'll be delighted to know, Governor, that the Christmas card you kindly sent me was not put with the politicians and other curiosities displayed. It went to the main mantelpiece alongside.
Thank you very much.
You were between Borussia Dortmund Football Club and the Ambassador of Nepal. So should bring comfort.
There is no answer to that.
There is no answer to that.
There's no answer.
To the nation, and
Although you don't want to mention to Tottenham fans that you got one from Borussia Dortmund.
Are there any fundamental disagreements between yourself and the ECB over the agreement when we left the European Union on financial services?
Well, there is a difference of opinion between us and European authorities in terms of the risks. Principal disagreement or difference of opinion is between us is about the risks associated with unclear derivatives in the event of a no deal, no transition scenario for Brexit.
No, I meant in the context of a deal scenario.
Oh, the deal. Well, to be candid, we don't talk about those scenarios because neither of us are involved in the negotiations, and so what we're managing is the current situation, anticipating what the risk would be if there is not a deal, and trying to provide the advice and put things in place. I would say that with respect, and I'll pan back, the cooperation with ourselves and the ECB with respect to preparations is for a no deal scenario is exemplary from our perspective.
I understand in relation to a no deal scenario, but in the deal scenario,
yeah.
Are there any fundamental obstacles to having a deal that relates to financial services?
I can't put my finger on one, no.
So we could be confident that there are some fundamental issues in relation to customs politically here that's quite evident. But in terms of financial services, if there is a deal here, then we could be confident that financial services itself would be a smooth negotiation.
If I could just re-emphasize, it's not for us to negotiate. It's not for the ECB. I thought the question was specifically with respect to the us and the ECB.
It is, yes.
Yeah. So, but neither of us are party to the negotiations. From time to time, I'm sure both of us might be consulted on technical aspects that would inform the negotiations. There are, as you well appreciate, I know, there are a host of fundamental issues in financial services that would have to be considered in any negotiated deal.
But you seem relaxed that they could be reached.
I was answering specifically. No, I was answering specifically with respect to the ECB, the sort of workings of central banks.
No, it's important for us to know whether there's any fundamental issues that you and the ECB are seeing in terms of should there be a deal.
Well, I mean, may I broaden it out slightly? You can stop me if you disagree with this, but. There are fundamental issues in terms of the division of responsibilities, the flexibility of supervisors to take decisions. Many of the decisions we've discussed today we take because we have independent macroprudential responsibilities and powers given to us by Parliament. Of course, it would matter if, for whatever reason, the nature of the deal shifted those responsibilities either to other authorities or somehow constrained our ability to take those decisions, such as varying the terms in the mortgage market in order to protect longer-term financial stability. Last point, high-level point is obviously the rules which govern our financial system and the evolution of those rules. It's a fundamental point. How the collective how the UK participates in their design and implementation.
And are you confident in relation to what your remit would be and the bank's remit would be should we progress with the deal into negotiations in relation to that aspect of the deal, in particular relating to financial services, and how you would be involved and how you would be advising?
Well, we recognize that this deal is about everything, and financial services is one component, and the bank is one component of financial services. We don't have good visibility, I guess the straight answer. We don't have good visibility to the nature of the future relationship, and we, like others, take note that a process is being developed to determine that. We would presume that as part of that process, before material decisions were taken about the oversight and regulation of financial services, given its importance and risk to the UK economy, that advice would be sought, or perspective would be sought, not advice, perspective would be sought as part of those determinations. But we fully recognize that the decisions are taken in a much broader context, and then we will implement those decisions as Parliament sees fit.
If Parliament muscles its way into a direct locus in relation to negotiations, how will your relationship with those negotiations alter?
Our relationship, we are not part of the negotiations. We have not been part of the negotiations in any way, shape, or form, with the sole exception of what's been disclosed publicly, which is discussions around no-deal risk, cross-border risks. We've talked about this many times in front of the committee. From time to time, we're asked perspective on technical issues. We provide those through the Treasury, as you would expect, and through testimonies such as these. But we're respondent, is the way I would characterize it. So if whoever is driving this process will get perspective if they ask, but only if they ask.
Thank you. Mr. Sharp, you've only made 3 speeches over your time, so I think we need to get value for money out of you today. And that's reasonable and fair, isn't it?
Totally.
So, what's going to happen to investment, seeing as Parliament doesn't seem to make its mind up about anything? What is the immediate impact going to be on investment, in your judgment?
As a result of?
Us not making any deals here. Parliament not deciding anything.
Well, I think you've got to look at the difference in time frame. In this lead up through this process negotiation, in terms of the data, it seems as though the liquid markets, people are neutral to underweight UK, and you see most of that particularly in the equity market. In the event of a disorderly exit, depending upon the severity, and you've seen in the work produced by the bank, there are different degrees of severity. It also then relates specifically, in my view, to also the question of the national credibility. If you look at the disorderly analysis that we've done, much of the decline in GDP that comes by 2019 is a result of the movement in interest rates, which occurs because, as we discussed earlier, we are influenced by external holders of our financial assets, plus spread widening. Now, so that's going to be driven by political uncertainty here, and the credibility of the government to manage their financial affairs, or the kind of political uncertainty that could come as a result of general elections or other things. So that's a very unpredictable but major factor that would then have a circular effect in terms of investors' willingness to actually move into the UK or contract assets further away. So in the short term, obviously there's very high risk. Short term, you'd expect to see the thing that we had around the referendum in play, which would be, and we built into our model as well, which is the foreign exchange acting as a shock absorber. And that allows then repricing to take place so that the risks that the UK represent are properly adjusted and we get a balance. But so I would say that this is a market people have stayed away from. There's some great attributes, which is the rule of law. There's underlying strength in the economy, and we're continuing to see illiquid investors investing in this market. But the liquid markets obviously will be negative in the short run. And then it comes to the different perspectives that this committee represents in terms of the growth prospects, the trade negotiations, the friction associated with trade.
So how will the market respond if Parliament grabs some of the executive power and decides that the 650 members of Parliament are going to manage the negotiations? What's your view of what the market reaction to that would be?
I can't obviously be precise, but I can communicate uncertainty and a lack of certain strategy, financial strategy, is only a negative because it adds a risk factor to the outcomes.
How long could we delay Article 54 and decisions before it has, in your judgment, a significant impact on investment and then on jobs?
You know, this is a personal view that falls out from my FPC.
That's why I'm asking. You're on the way out, so you're free to speak. Well, I'm not going to allow the governor to interrupt you.
All I'd say,
and he doesn't want to.
All I'd say is the history of negotiation. I've negotiated many large M&A deals, as the chairman has as well. Is that in any event, there's always tension right at the end, and if you put off the end, you will still have tension at some point towards the end. And certainly bilateral negotiations between sovereigns and governments have often reflected that in some of the trade negotiations you've seen. That's my way of answering the question.
And how, in your judgment, I'm not asking your view on what we should do, that's a political decision, but how big a difference, in your judgment, is this going to make, our decision, or indeed our non-decision, our decision to investment and jobs prospects in the country? I mean, how in terms of where you're seeing it, you're someone who will be advising, advising people how to spend money and invest. I mean, how big a decision is this? How big is the gulf in terms of direction?
Well, as you already heard, the backdrop is a slowing global economy, and that's obviously means that investment decisions in any event are constrained. And therefore there's more fragility associated with any decision to increase capacity in that environment. And then if you add another layer of risk on top of it, it makes it a pretty easy decision to hold back. So it's quite significant.
Final question. Would you be confident with your experience now of the bank when it comes to financial services, getting a good deal on financial services is achievable for the country?
Yes, I would hope so. I mean, certainly what I've observed, and I think we benefit from having a governor who has strong central bank and global relationships. The head of the ECB is a former colleague of mine as well. These are very constructive people that recognise mutual interest at the central bank level, and you've seen that activity in global accords in terms of protecting growth. So at the central bank level, which is where some of the regulation of financial services will take place, I'm quite optimistic that the individuals involved will be very constructive.
Thank you, and thank you for your contribution over the years.
Yeah. The trouble is with the politicians, when the negotiations left to politicians. Steve, did you have a supplementary?
No, I've got to go.
Right. The governor has one brief thing.
I only have one, just if I may, sorry, Mr. Sharp, but in the scenarios, the impact in the short term is tariff restructuring and dislocation, various customs related. It's not the interest rate response. The interest rate response is something that affects the pace of the recovery, and I think it's important that that distinction is just noted on the record. But it's just a scenario. It doesn't mean it's what's going to happen.
Well, I thank all our witnesses this morning. Can I particularly thank Mr Sharp, who, for inexplicable reasons, is not going to be in front of the Treasury Select Committee anymore. But we wish you very well, and thank you for your work on the committee. And we look forward to seeing the other witnesses again in due course. Thank you.